Good day, everybody. And it's nice to finally see you after quite a few months of quite a bit of turbulence into markets. But in recent weeks and months, we did see a healthy recovery from the market. And I'm happy to be able to present a little bit more rosier outlook than what we looked at in the last year or so. So to be able to generate a sense of what we'd like to present today, keep in mind, again, one of the famous statements of Warren Buffett, and I think would apply quite aptly in these days. And he said, be fearful when others are greedy and be greedy when others are fearful. And the reason I'd like to be able to present that is because, today's environment is still not a rosy one. People still are talking about a potential recession in the US and all sorts of things, and headwinds still are very much about. And it's really because of that I think that it really might be a good time to look at markets, because if we wait for everything to be clear, to be good, to be great, by that time prices would have already climbed up quite a bit, and the opportunities for us to be able to make money in markets like this probably would be a bit more graduated, and maybe a little bit more limited. But today we're coming off a very significant picture for markets, and I'd like to be able to share you my opinion on that. So the picture I'm showing you today is a view of the PSEi index. And the red line that you see here in the middle is where the market was when we last spoke to you back in September, when we conducted our mid-year market outlook. And during that particular phase, it was quite a treacherous situation, because our index was coming back down close to previous lows. And in fact, we were saying that there's quite a possibility that it could test the 6,130 to 650. And even if it breaks it, it could even capitulate by falling down to about 5,730. And just to be able to show you what actually happened then was this. So the market, after breaking support, it did come inside and capitulate. And we did see a market bottom quite close to what we were looking at, 5,730, where we hit something about 5,700. And thereafter, we saw the market manage to do an interim base and gradually zigzag its way all the way up to where we are today. And now we're reaching the thresholds of about 71, 7,200. And if you can see this picture I have here, we're roughly at the high band of a channel that I projected upwards. And I think at this stage, we'll probably need to be a little cautious that potential short-term corrections might interrupt our recovery from what we've looked. To be able to highlight some of those zones, I've pasted some of these ranges here on the right side for your guidance. I will go back to this later, but let's talk about what's actually been happening since. So there was a period before when we were looking at, we were all concerned about inflation keeping its very high head up there. And because of that, we were also worried that potentially interest rates could start climbing, which it did. And what's happened since our market outlook? So we did see some tapering in inflation back in the US, but in the Philippines, we just moved sideways. But then what happened after? We continued to see a downward trend in US inflation, although Philippine inflation had a very different story, because it still managed to be able to trickle up. But in the last month or so, we saw relatively flattening of inflation, to which we hope soon we'll probably see it taper, maybe even come down to be able to help out in giving us much more advantage situation for our country. If you were to look at another headwind we were also looking at, is that we were seeing a very sharp appreciation in the dollar. We were also seeing weakness into the dollar peso. But since that time, you can see the picture here, we've seen that the dollar has managed to come back down, with the dollar index falling closer to almost 101. And we saw that the peso-dollar rate has gone down to about almost 54.50 in recent days. So since these were one of those who were adding headwinds to us, clearly by this pulling back down, we're seeing that alleviate the pressure that we've been seeing with some markets. Furthermore, we've also seen that the US 10-year bond yield managed to also climb up quite strongly, because we were thinking that this could stay relatively lofty because of the high inflations we were seeing. But since we've seen inflation taper, this is what happened to bond yields. So if you notice, we did still see an up move come towards 1 month more after our outlook. And thereafter, we saw a downward swing take place with lower highs into the 10-year. And that even manifested into the Philippine 10-year bond yield, which I think was the biggest contributor to our market generating the rally that we're seeing today. Mind you that these particular types of corrections were happening in the yield market, which I believe is a leading indicator as compared to what you see on the right side, which is the actual interest rate levels that we're seeing today, which still are relatively lofty because central banks across the world are still trying to be able to make sure that inflation comes down and that they don't pull it down too early before that actually happens. But yields are already telling us that that ability for things not to be as bad as what we're looking for has already taken place. And finally, the effect into markets have been quite clear to us. So if you were to look at the S&P 500 and the PSEi, where we were in the last outlook, we were still on a corrective path. And if you were to notice what happened after, it fell down a little bit more, all the way down to that October low that we've seen. And then markets have spent their time recovering. If you notice, between the S&P 500 up on top, the PSEi index here in the lower left bottom, and the emerging market index in the lower right side, you will clearly see that the US market seems to be lagging quite clearly as compared to what the Philippines managed to do and what emerging markets managed to do. So this is telling us, obviously, there's something in the US that's still structurally wrong and may take its time to be able to recover, perhaps not going to be as fast as what we're seeing into some emerging markets, including what we're seeing into the Philippines today. So why is the market rallying when inflation and interest rates are still relatively high, you might ask? And the reason behind that is really to ask the question, what is our market pricing in? Why is it climbing despite these headwinds? And I would have identified these things for you so that you can kind of understand why. Remember, markets don't move with what's exactly happening right now. They tend to look ahead because when you invest money today, you're putting that money there for a future return. And so when people are investing money, they're looking down the road. They're not looking at today's situation only. And what that means is, what are they pricing into this condition? And my belief is that, one, they believe that inflation is slowing down. Two, bond yields seem to be accepting the same, as we've seen a correction in the yields, as I showed you in the previous slide. Three, the dollar and even the peso has managed to tame itself from the weakness or the strength of the dollar and the weakness in the peso that we've seen earlier on. And for the possibility that that we could see a not so hard landing of what many analysts or fundamental analysts are still talking about today, that might happen into the US. And so people are saying maybe it may not be as bad as what many of these people are saying, precisely because inflation is finally coming down. Maybe interest rates may soon do the same thing, and not so much volatility will take place into the currency, maybe even the commodity markets. And that all in all is helping the sentiment today. But what is not being priced in? I think that's also an essential question, because this is something that we have to be able to prepare for. One, I think inflation and commodities rallying from where they had, because they've come down and shown quite a bit of a pullback already. And so perhaps a rally could be somewhere in between before maybe tempering again. And that rally could cause some volatility. Two, the same thing with bond yields. We'll probably also do the same, because if we see inflation hold on or even rally even a little bit, I'm sure yields will come up right away. But I believe that that will be temporary. And the same goes with the dollar. If we see yields rally, the dollar will follow. And of course, what happens if we do really see a hard landing into the US? I think that can also take some people by surprise, because many people seem to be saying maybe it might not be so hard. And if this really comes up, they will probably have to rethink things. And last but not least, of course, could there be an added war drama into the situation, either in what we're seeing in Ukraine or any other part of the world? And these could also cause quite blips into the market. On the positive note, what could not be priced in as well? Well, could some central banks actually decide to do some pivoting maybe before the year ends? That would clearly be a welcome surprise. Another one could be maybe the recession in the US may not be bad, or even maybe not even take place, although that might be far-fetched, but I will just leave that open. Another will be China reopening to be able to pull itself out of the current COVID malaise that it's currently feeling, and help on with the ability for things to be able to increase the supply logistics of things. And who knows, maybe there could be a cessation to war, or maybe a peace treaty done after all this is taking place. And all this could be positive catalysts for markets. Now, a little look back into the peso, because wow, we went into quite a bit of a seesaw into the peso-dollar rate. If you see the picture we've had here, when you're looking at about the second half last year, where we saw a massive weakness into the peso rate because of the strong dollar, and then U-turn itself and fall all the way back down to where it is today, closer to about 54.60. This area where we are now is a very critical area, because I believe this to be a junction of heavy support. And if this manages to be able to hold, we might see that interim recovery I was talking about earlier on, maybe in line with the dollar. But again, I don't think this is one that will rally back all the way up to the previous top. Maybe just make another lower high here, and then eventually attempt to be able to move back to where the clear support areas is. If by somehow we can still see some strength into the peso, and we see support break, support currently is roughly about 54.20. If that happens to break, the next support is quite far away, because the next one would be closer to 52.65. And that might also warrant some attention back into local equities, as people say, hey, maybe I can take some gains into the peso while investing in local stocks as well. So that's something worth watching as well. In terms of commodities, in case some of you are looking to be able to play out on some issues here, not so much on activity I would look at into oil, although it could rally a little bit, but I think this will just get stuck into a range and not show much of a rally. So I don't really feel any spikes are going to be warranted in oil as of now. However, in industrial metals and precious metals seems to be where the action is. Copper have been very strong, so has gold. This could both be steered because we've had a weak dollar, and that would contribute to this particular effect. So if the dollar managed to make a little bit of a rally, you might see some tempering into these two particular metals as well. And finally, another industrial metal, which is nickel, which has managed to be able to soften. I think this one will probably just see it range between the 2600 and maybe the 2300 zone for the meantime. I don't see any aggressive moves just yet right now, but if it can climb closer to 26, then I will review that possibility. So right now, maybe we'll see nickel manage to be able to just round about into a consolidation. Now, going to one of the most important markets around the world is we have the US, where the S&P 500. Let's look first at the chart below, because this is where it is today. Now, what I did is on top of it, I put in a picture which I did show to you last time, and I was saying that we were following a path into a corrective movements. At the time, we were only seeing interim rallies. But now there's this situation where the index is now threatening to be able to break out of this downtrend line, similar to what we've had here during the dot-com bust. And once it did manage to break above that trend line, it also generated another technical positive indicator called a golden cross. A golden cross is when you see that the 50-day moving average crosses over the 200-day moving average, similar to you see this blue and green line cross over here. The last time this crossover is way back here, and that generated a bearish market for quite some time. In fact, it lasted a few years. Today, we are also currently still into a death cross environment, because we don't actually have a golden cross into the S&P. But here we are attempting to be able to make that challenge. And if we do manage to get a break of that downtrend line, and we see the S&P go over 4,100, that golden cross more likely will take place, and that should be able to deliver a much more bullish sentiment into the US market. If it fails to break through this trend line and we prove resistance to be strong, then I will review it back that there could be one more downswing into this US market before it generates its bottom and makes a recovery. Clearly, a lot of markets may not like that, but I don't think all markets will force itself down like the way the US is. This will just probably delay things or defer things a little. If you were to look at other markets, and this also contributes to why I'm relatively bullish, you would see here already that in the iShares in Germany, Japan, Thailand, and China, they're already clearly seeing advanced signs that their indices are already climbing over major moving averages and even sporting golden crosses, as in the case was in Germany, Thailand, perhaps maybe soon in Japan, because they're currently testing it right now. But clearly the index is higher than those two moving averages. And these are all showing me bottoming out types of patterns. And this is obviously why I'm saying that markets are generating this bottoming out phase today. China may not have been showing that golden cross as of yet, but again, simply just like Japan, there could be a possibility of doing the same. Now let's go into our market. Now, I've actually been drafting this almost day by day in our technical spotlight. So if some of you would like to be able to follow it, please go ahead and review some of the daily events that we were talking about. But I've managed to be able to pattern the PSEi's movement, which is what you see here today, in equivalent to what we saw back in 2019 and 2020, almost exactly at the same period in January. Now, if you notice the same, I've even colored the area so that you can try to highlight what we're seeing. We're currently at this rally phase here, similar to what we saw in January 2020, a rally phase here. Market started to zigzag, maybe extend a little bit more. And after that, the market had to be able to go through a corrective consolidation. I think we're probably going to be following something closer to this with this type of formation you see in the bottom. The only thing that I am not yet sure of is whether we're going to begin it right now, or maybe the market can excite itself one last time before actually entering that consolidation. But on either case, we will go through this. And I will add another reason why that will happen in a little while. And just to be able to figure out the potential movements here, our resistance is between 7,100 and 7,200. If it excites itself, like I said, then maybe extend to 74, 75 if we're lucky. And then eventually attempt to make a correction back. I'm thinking maybe closer to 6,650, maybe even 6,400 as a potential area of support. And if we do get there, please take up the opportunity to be able to position correctly in those areas, because I think that will be a good opening for Miami to be able to position for this recovery phase. Eventually, and I hope if not sometime towards this year, if not very, very early next year, 7,500 to 8,250 might be quite a clear target for us to be able to look for into the PSEi index. Another thing that I've also talked about last September is the type of bottoming out phase that I think that the index would have done. And I presented two scenarios. The blue dotted line here, which shows you that a correction that just retested the low and rally, or it could come and capitulate and show a lower low scenario than what we've had when we were presenting to you, but not go all the way back down to the low that we've seen here, bottom, and then turn up to be able to rally. And this is what actually happened. So if you see the index today, you will see that the bottom that we saw here, pretty much the area where we were talking about, and eventually the market did make a recovery back to where we are today. Now, the reason also this suggests quite a good reading for me is because at that time, I already planned out a 5-wave Elliott wave swing over here, and potentially with the wave 5 not going all the way back down. This is what we call a truncated fifth wave or a shortened fifth wave. And it happens if the situation becomes bullish faster than the norm. And that to me is also another reason why we should be very watchful of the market. And of course, the 71, 7200 areas where a major downtrend line sits. And that's why that also poses as a challenge into the short term. So it's possible it could hit its head here, back off, make a higher low again, and eventually break that. And after that, we'll probably see a much stronger market. So in given the context of the PSEi, why do I want to just temper my bullishness in the very, very short term? Number one is because we've had a rally since October. We're now coming closer to resistance. And uh, we have actually seen many times in the past that in January, we tend to see some major turning points. So far in the last Januaries, we've seen most of those turning points were pretty much tops. A top here, 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 here. And because of that, some of them were actually coupled with overbought signals as well. And we are kind of in the same boat today. The market is quite overstretched. We're coming towards the end of January. And we've just seen a major rally from October to this period. So I think we better be quite watchful that potential corrections could come. Another thing is by checking seasonality, you would notice that in the last 6 years, you've noticed that Feb and March, excuse me, tend to show very weak readings in terms of outcome from the Philippine index. And it shows that in general, only showing 20% of the time did it actually record a positive end of month swing. And in general, about losses of about 0.2% to 0.6% for Feb and March accordingly. Whereas clearly in January, we've seen much higher chances of a potential positive. That was 67%, showing gains of about almost 1%. So here we are in the same thing. We're good in this month, but perhaps these are good times to be able to show a correction. After that, we could be looking to position into these months in view of potential recovery in a few months later. So in terms of summarizing that, so in terms of the US, I think that the US is attempting to rally and break through a consolidation, but it's approaching a key resistance. The S&P needs to break above 4,100 to be able to re-angle itself to a stronger recovery. If it fails to do that, it could back off one more time. Two, interest rates, by looking at Philippine and US yields, have already shown you that they don't think that we're going to go way up there to what a lot of people were talking about very much 1 or 2 years ago in terms of interest rate projections. And although there could be a rally that could cause some hiccups in between, we don't think that will be lasting, and we think that will be temporary, and then we'll probably see that slow. The dollar and the peso, the volatility should start to be able to wind down. But if we do see a little bit of a rally in yields, we might see a rally into the dollar. We might see the peso lose a little bit. But again, I feel this is temporary. And I think that we should be able to keep ourselves relatively good and not go back to the bad ends of what we saw last year. Commodities, I don't really see too much threat in oil anymore. I think we'll probably just get set consolidations for the meantime, although we are seeing some selected strength in some industrial metals. So if some of you are positioning into some metal mining stocks, I mean, you can continue to do that, but please be watchful of the US dollar because that could tick in. And finally, and more importantly, the PSEi, I think a lot of bullish signals have just recently come out. We've seen it break through the downtrend line. We've seen it break through the 200-day moving average. We've seen it generate a golden cross. These all presents bullish signals. It would be nice if one day we can break the 7,200 area, but maybe in time, maybe after a correction, that would probably be better because we're kind of overstretched or overbought right now, and that we have to be able to account for a potential pullback into better support levels for us to be able to buy back in better ranges. So I'm looking, like I said, better ranges for a correction between 650 and maybe even 6,400. So look to accumulate into these pullbacks as we look for a potentially higher index, something looking between 7,500 to 8,250. So let's go a little bit more strategic now and talk about a bit what to expect. So what this correction I'm talking about could be something like this. It could be a mini ABC correction into your index, gravitating back to some of the levels I talked about earlier. Once after we see that, I think these will be much better areas to be able to look for buy windows for many of you. So if we were to take that position into a company, let's say like Ayala Land, and you would get corrections like this, you might see Ayala Land maybe pull back closer to maybe seeing the trend lines or even the Fibonacci levels, 38, 50% be tested. I would prefer it would not go to the 61.8%, but that's still a possibility because the property sector was not as strong as many of the other ones that we looked at earlier. So that could still be a possibility for Ayala Land. Another good thing I've seen is that in recent weeks, we've had good net foreign flows into the market. So again, I think that's a clear factor that some confidence is being regained into our area. And clearly that will very much help out some of the issues that we're looking at. Now, this is a scatter diagram of the PSEi 30 index members. And some of them are showing improving conditions, leading, weakening, and lagging. These are all drafted using the index performance as its base. So if you see an issue on the upper right hand, it says leading, that means it's leading the index. If you're seeing it on the lower left side, that means it's lagging the index. So where would I cast my trading net if I were to be able to look at some of this? Well, I would cast my net in these quadrants right here. So all the issues that you see inside this particular area, I think this is a free-for-all for us. Just simply wait for prices to correct better to stronger support zones. And I think you'd probably pick up quite a good amount of issues that should be able to do well into the period that I was talking about earlier. I would like to concentrate into the financial sector and into the consumer-related sector because these were one of the first to be able to move. And I think that despite their strength right now and into a correction, I would use that as an opportunity to be able to position myself into these particular companies. So BDO, BPI, Metrobank, Union Bank, these are what I like. There are a few banks also, but I would top mine off with these ones. The blue target prices that you see here highlighted in blue, these are the preferred buying ranges because these are where we see closer technical ties to major support. So with BDO 117 to 113, BPI 105 to 102, Metrobank between 57, 55, 50, and Union Bank at 91 to 89. In terms of some consumer-related issues, Robinson's Retail, Jollibee, DNL, and SM are clearly on my radar. The first two, Robinsons and Jollibee, they're generating area patterns right below resistance. So it's something worth watching. It looks like it's being accumulated, but it's still encountering some selling pressure in the high band. So maybe we don't have to be too aggressive until we see breakout conditions come. And in terms of DNL and SM, you can see clear breaks of recent highs and prices seem to be standing off those major areas. So these are major reversal situations, and they should look better down the road when we're talking about into the next 6 months. So take the opportunity to be able to buy within these blue price zones again for these particular 8 companies that I presented for you. For some of you who want to be able to look at the index broadly, you can take a picture of this, and I will send this in a later spotlight so you can have a copy of this. That way you can see potential targets of some index stocks. When I say targets, these are next resistance zones. Stops I've placed into next support zones. And what do I recommend in terms of the trading capacity for each? So when you talk about WFP, just look at the legend below. That means wait for pullbacks. Majority of my recommendations are like that because of the overexcited conditions of markets right now. But I feel strongly that pullbacks from here would be your opportunity to be able to position well and to be able to ride the rest of the recovery from that market. So please take a picture of this and paste it beside you so that it can help guide your hand in terms of looking where to be able to make timely purchases or whether you'd like to stay and hold to your target later on. So with this, I hope that I've managed to be able to present the detail of that. And just to be able to conclude my thoughts, the PSEi has shown us already a viable bottom and is now moving through its first major rally after generating its base in October. Its stretchiness, however, seen because of its stretch from October to January, might need some temporary corrective action. And I feel with the January effect that I've shown you, there's a good chance that we could see some corrective volatility into the Feb-March area. There is a chance, though, that the rally could extend a little bit more, maybe towards the first half of Feb. And maybe that would give us a good reason to at least keep some of our positions inside. You don't have to sell everything in this area. Anyway, remember, you're in a major recovery here now. We're just going to try to see if we can sell a little bit and position back at a lower price. That's all we're going to try to do over here as a strategic move. In terms of the US, this will continue to lag. And if some of the bearish calls of fundamentalists do come out, I think that might generate some volatility again through other markets. So just keep that in check so that we don't have to be extremely too aggressive. But I think once the market corrects, you can be aggressive buying your issues already into that. And then, of course, markets seem to be pricing a lot of the negatives already, except for the ones I highlighted that has not been priced in. And it has shown us resilience despite that. The breaks over the 200-day EMAs, the golden crosses, downtrend line breaks, seeing the pullbacks in bond yields and lesser volatility in currencies, they all tell me that people are starting to take up risk again. And that fear of a massive sell-off perhaps is no longer very much on the table. And that means that puts us into much more bullish situation today than what we talked about in our last outlook. So I hope with that you've managed to be able to give yourself good clues as to what to be able to look forward to. And I'm hoping to be able to see you into a better 2023 and maybe even a better 2024 into our next market outlook. So thank you very much. And we'll move on into the next speaker.